Welcome to Selling Premium. This is a part of the class where we discuss if you should sell bullish, bearish, or neutral premium. So let's go ahead and dive into this a little bit deeper. First of all, talking about call credit spreads, like I explained in the previous session, this is the bearish play. It can also be a sideways play, but the moral of the story is that you're looking for the ticker not to cross through an overhead strike. So, the ticker can trade up to your strike and then down, but honestly, it's a lot easier if you just time it so that you're doing it against an area of resistance, and then you can sell it at the high while it's falling down. That is the easiest thing. In our instance, where you're using the standard deviation, it's also easier to sell premium to the upside after it has made a high, just because, if you do it when it's on a dip, then it will rally back and it will give you a little bit of stress. And so that's why it's easier if you try to do it on an uptrend. Anyways, moving on, talking about identifying the trend. An uptrend is when we sell premium to the downside. A downtrend is when we sell premium to the upside. And a choppy trend is where we sell iron condors. So let's talk about the trend direction, choppy or bearish. In a downtrend or a choppy market, I focus on call credit spreads and iron condors. So let's talk about selling the call credit spreads. Well, it's good to do this during a downtrend, and you can also couple it with iron condors, or you can pick one of each. Call credit spreads are not to be sold on strong bullish stocks. Why? Well, because it's more likely that these stocks can break out to the upside. As such, this is only done on bearish and choppy tickers. How do you sell a call credit spread? Well, I use the calendar formula, and that's not calendar, the type of trade. That is the calendar that I have given you. You want to use the calendar, and you look for a Tuesday, Wednesday entry. Then you use a spreadsheet to determine the strikes. Then you enter the trade. If my trade is up by 20 to 50%, I will close it within 3 days. If not, I will wait until the next week and close it at this time. If my trade is at a loss, I will look at risk management parameters. So what does that look like? Well, if you're getting in based on the calendar method, that would be entering on a Tuesday, trying to exit on the Friday, and definitely exiting by the next Tuesday. You're not waiting until the very end for all the theta to decay. Why? Because at the end, that's when it decays the fastest. You have a little bit more risk in that manner, just because it's right at the end. You don't really have time for it to come back. And so your biggest area of profit is going to be from here to here and then to here. After this, you're kind of in the danger zone. So you want to try to avoid being in that area. When you're looking at your spreadsheet, a couple important things to note when you're selling call credit spreads are you want to note the 10-day high. Why would you note the 10-day high? Well, it's better to sell something that is above the 10-day high. Why? Because if the stock has traded like this, you're going to have a high over a 10-day period, which could be here, okay? So if you're selling a 1 standard deviation strike, you want to sell it outside of that high. You don't want to sell it inside of here, because that's where the stock has recently been. You want to do something. You want to sell it outside of the 10-day high. Another number that you can use is the 5-day high. So I kind of go back and forth between the 5-day high and the 10-day high. But the moral of the story here is that you need to be paying attention when you're selling out of the money premium to what the previous highs have been. The other thing to note on your spreadsheet is to note, okay, you're getting in on Tuesday. What was the 10-day high? What was the 5-day high? What's the expected move going into this week? Okay, and then you want to note your standard deviations for both the calls and the puts. It's always great to write down your trade. You need to know your risk, and then you also need to know what happened. Did it expire? Did you close out? What was your P&L? Now, remember, it's easiest if you close out your trades between 20 to 50% profit, okay? The reason being is because you want to avoid those losses. Closing trades for losses, especially on a strategy like this where it's very high probability, but you're doing trades that are out of the money, your risk reward situation is going to be very high. So it's ideal if you just take the slow and steady 20 to 50% gains, close them out, and don't be greedy. Now, let's go ahead and talk about put credit spreads. So why would you do this? You would want to do it in an uptrend or choppy market. I focus on these put credit spreads or iron condors in a market that looks like this, choppy, or nice solid uptrend. My favorite is the uptrend because I like to maximize that with calls as well, but you can also do the iron condor if it's pretty choppy. Let's talk about selling put credit spreads. Now, why would you do this and when? Like I was saying on the previous slide, you want to focus on this type of strategy where you're selling premium to the downside on an upward trending stock. So as the stock trends higher, you sell premium. It's at a high, you wait till it pulls back, you sell premium. It's at a high, you wait till it pulls back, sell more premium. Call credit spreads are typically not sold on a week, Nope, that's the opposite way. Put credit spreads are not sold on weak bearish stocks. Why? It's more likely they could roll over and die to the downside. Sorry, this is supposed to be put credit spreads. I'll go and change this right now. Put credit spreads are not sold on weak bearish stocks. Why? Because when something is trading lower, you don't really want to be stepping in front of a freight train by selling put credit spreads down at the lows. So I'm going to make sure to go change that in the slideshow. All right. Next piece, selling put credit spreads, the how to. Okay, so same thing here. You're using your calendar formula and you're using your spreadsheet. You check the results with your Analyze tab. You look for an entry on Tuesday, Wednesday. You use the spreadsheet to determine your strikes. You enter your trade, and if your trade is up by 20 to 50%, you'll close within 3 days. If not, I'll wait until the next week and close at that time. If my trade is at a loss, I will look for risk management parameters. So here's your calendar again. It's the exact same thing. Enter here. You try to get out here 20 to 50%. If you're flat, if you're not profitable, then I'll just wait until the next Tuesday. But you really do need to be out by this time. Don't try to be greedy to wait until the following day. Remember, you're getting into a trade here with about 2 weeks till expiration, so you have time on your trade. The other reason why we do it this way is because you don't want to have a ton of risk. When you only have risk spread over 1, 2, 3, 4, 5 days, you have basically a 5 day period where you're hoping that there's no, massive news on the stock to send it to a 1 or 2 standard deviation move. So again, with your spreadsheet, when you're selling put credit spreads, what you need to do is you need to note the 10-day low and the 5-day low. Same reason here, because when your ticker is ticking up this way, where was your 10-day low? It's down here. So what is that number? Is it 100? What is it? So when you're selling put credit spread like this, you want to know what your 10-day and 5-day low was. So you can write it here. My 10-day low is 100. My 5-day low is 105. So what you want to do is you want to sell outside of this range. So you want to look at your standard deviation calculator right here. And let's say one standard deviation is going to be 98. Or sorry, not on the calls, 98. Okay, and then let's say it's 95 and let's say it's 93. That's not right, but I'm just doing it for an explanation. So then you look at this and you say, oh, okay, well, is that outside of the 10-day low? Yes, it is. Okay, that's great. So when you're selling premium down here, you're selling it outside of the 10-day low and you're selling it outside of the 1 standard deviation move. If you want to do it a little bit tighter, you can sell it outside of the 5-day low and outside of the half standard deviation. But those are going to have to be taken off even closer. And then, of course, like I also said, you can do the at the money, put credit spread, just like that, where you're going to be selling it right at the money for a much better credit, but still keep in mind the 10-day and 5-day highs and lows. So just going to check out your calendar. I mean, really everything that we're doing is based on the calendar, and you also need to use your risk parameters in mind. If it's up by 20 to 50%, then I'm going to close within 3 days. If not, I will wait until the next week and close it at that time the next Tuesday. The reason is because you do not want to have risk on. Now, of course, we need to talk about as well, what about risk management parameters? So this is very important, especially with this type of strategy. You really have to be careful because it's out of the money. You do not want one loss to wipe out like 10 of your gains. So what you need to do is you need to make sure that if your trades are getting to about a 30 to 50%, anywhere between 30 to 50% loss, it is much better to just close it out because you do not want a max loss. We do not want a max loss. So it's much better, believe me, to get a 30 or 50% loss than it is to get a max loss. All right, so the next portion of this is selling iron condors. How do you do that? Same exact thing as the previous two explanations that I just went through. You want to look at your spreadsheet, look at your calendar, look at your trend, same exact thing. The only thing that is going to be different is going to be placing 2 legs of it instead of just 1 leg. So, on a put credit spread, you're selling here, selling here, selling here, selling here. Okay? In a call credit spread, you're selling here, selling here, selling here. With an iron condor, you're going to be doing this on both sides. So here's your stock. You're selling here, selling here, selling here, selling here, selling here, selling here. So you're selling on both sides that while the stock price trades, your theta is just decaying for you. So again, same format. Identify the trend direction. You want something that is choppy. Again, same thing here. You start with your calendar, entry, possible exit, definite exit. Then you put on some new ones. Then you have some exits here, exit here. Now you put on some new ones. Same exact thing. With your spreadsheet, you need to make sure that you note your 10-day highs and your 10-day lows, your 5-day highs and your 5-day lows. So if you're doing 1 standard deviation, it needs to be outside of your 10-day highs. And if you're doing a half standard deviation, it should be outside of your 5-day highs and lows because this is going to be a little bit tighter for a better premium, okay? So we're going to make sure that we get all of that right. So for example, something like Ulta, you can do this strategy at different times on the same ticker. So for example, right through this area, this is when I would be selling put credit spreads. Put credit spreads the whole ways. Then you kind of get to this point where the trend strength candles shift. You have your moving averages that get sloppy. You have your candles that turn red, and we're trading in a range. This is where you can do the iron condors. Or you can pick a side. You can just sell the puts. You can just sell the calls, just sell the puts. And then here we're back in an uptrend and you would do put credit spreads in that uptrend. So I hope that you have enjoyed that explanation of iron condors, put credit spreads, and call credit spreads. Now we're going to get on to a very important part, which is called always risk before reward. Before reward, acknowledging risk and managing it. So I'll see you in the next video.